So guys, the market has been absolutely pumping lately, and while there's no shortage of stocks that have just seen crazy gains this last month, there are quite a few that I think still look like pretty good buying opportunities, and in this video we'll be talking about 3 of them, all of which I think are worth considering as we get ready to close out 2024. But real quick, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. So guys, stock number 1 on our list today is Clear Secure, ticker symbol YOU, which is actually the newest addition to my portfolio. I just started investing in this company like a couple of months ago. And you may not be too familiar with this stock because it's pretty under the radar, but I'd be willing to bet that you do know the company, especially if you spend any time in an airport. You know, when you're going through security, you get in that line where the TSA agent checks your ID and boarding pass. Well, instead of waiting in that line, which as you probably know, can sometimes take quite a long time to get through, Clear has its own special lanes that let you bypass all of that. In the Clear lanes, you just do a quick biometric scan to verify your identity, and once that's done, a representative takes you straight to the front of the security screening area, which can save you a lot of time and a lot of frustration, especially during periods where the airport is especially busy, like right now during the holiday season. And although airports are the company's bread and butter, at least for now, Clear service isn't limited to just airports. You can also find this company at a handful of different stadiums and event venues around the country, like Allegiant Stadium and T-Mobile Arena here in Las Vegas, where you can use the same biometric identification process to get through security when you go there for an event. Now, like I said, I started buying into this company a couple of months ago and have been dollar cost averaging into my position every single week, which has been a lot more fun lately after this stock's recent and substantial pullback. Taking a look at the share price performance over here on Snapstock, which you can get access to when you become a member of the investment club. And if you want to learn more about that, there's a link to it in the description of the video and in the pinned comment. But anyway, guys, back to the share price performance. Just in the last 30 days, Clear has seen a crazy drop. The stock is down 26.33%, and we can see that it really fell off a cliff right here after peaking at around $38.50 per share. And this drop that we're looking at right here, guys, came after they reported their quarterly earnings, which I think is kind of interesting because the earnings were actually pretty impressive, at least in my opinion. Revenue for the quarter was up 24% year over year, and for the first 9 months of 2024, revenue is up 27%. So that looks good, and with that, earnings per share also saw very substantial growth, climbing to 30 cents this quarter from 21 cents a year ago, which is a 43% increase. And over the 9-month period, earnings per share is up a whopping 124%, which is just insane. So all of that so far obviously looks really good, and none of that caused this crazy share price drop that we saw. That was caused by the free cash flow numbers for the quarter. For Q3, Clear reported a free cash flow loss of nearly $38 million, which understandably prompted some investors to make their exits. With that said, though, this free cash flow loss for the quarter was not at all unexpected. Clear actually told us this was going to happen in the last quarterly earnings call, and there's a clear explanation for why. Clear has a partnership with American Express, which allows Amex cardholders to receive discounts or even full reimbursement on Clear memberships. Now, while Clear recognizes revenue from these memberships, they also pay a portion of that revenue back to Amex every year, and that payment takes place in the third quarter of each year. So that's obviously going to have a negative impact on the free cash flow, but ultimately this partnership is still a win-win. Clear is able to attract more customers through American Express, and American Express is able to offer additional perks to their cardholders. And despite the free cash flow loss this quarter, when you zoom out and look at the bigger picture, Clear's free cash flow is still seeing crazy growth. For the first 9 months of 2024, the company has generated nearly $150 million in free cash flow, which is a 37% increase compared to the same period last year. So overall, at least from what I can see, Clear is showing multiple signs of a business that is just firing on all cylinders, and I think it has a lot of the makings to be a great dividend growth stock. While they don't yet have an extensive dividend growth history, what they've done so far is pretty incredible, as we can see here, and if they just keep delivering raises like this, we'll be in good shape. And this strong performance and these dividend increases means that for long-term investors, the drop in share price like we saw isn't a setback, it's a buying opportunity. Like I said earlier, I've been dollar cost averaging into this one every week since I started the position, and I've very much enjoyed being able to buy shares for as low as, $25-26. And if we take a look at my Clear position over here on my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. But after all this great buying lately, we can see that I'm now left with 82 shares of Clear at an average cost of $30.60, which is still a few bucks above the current share price, but this average cost has come down quite a bit through all of that dollar cost averaging. I think that before this big share price drop, my average cost per share was sitting at around 30 $33, maybe $33.50. So I've really been able to lower that just by buying at a lower share price, which is fantastic. But still, at this point in time, guys, I'm seeing a 12.5% loss, but it's nothing we can't recover from. At least for the foreseeable future, I'm going to continue putting my money where my mouth is with this stock. I'm pretty close to getting to 100 shares. That's like my first initial goal with this position, and then we'll just kind of go from there. But anyway, guys, now moving on to stock number 2. This one needs no introduction. We're talking about Target, who, as we can see, like Clear Secure, has also seen a pretty big drop in share price in the last month. The stock is down about 15%, and they're also down another 2.25% just today. So some pretty big drops here. And if we zoom out looking at the year-to-date performance, Target is still in the red. In 2024, Target is down about 6%, and zooming out once more over the last year, Target is down about 1%. So it is underperforming the rest of the market by a long shot. Now, Target's big drop this month also came after they reported their quarterly earnings, where they missed on both the top and bottom line. And it looks like the earnings miss here was pretty substantial. With that said, though, there were still a few positives to come out of the report. First, it looks like guest traffic was up about 2.5% year over year, and digital comp sales really took off, up 10.8% year over year, which reflects nearly 20% growth in same-day delivery powered by Target Circle 360, which is Target's paid membership where you can have your order delivered straight to your front door. But anyway, along with these, beauty comp sales were also up 6%, and food and beverage was up low single digits as well. So like I said, it wasn't all bad, but it was still mostly bad. And the company lowering its guidance for the rest of the year was definitely the nail in the coffin. Now, while it's true that Target's recent earnings didn't inspire a whole lot of confidence, I think this drop in share price has created a potentially really good buying opportunity for long-term dividend investors. And there are a few reasons why. First of all, Target has a long history of being able to persevere through the ups and downs over the years, during which time it's maintained its dividend growth streak to the point where Target is actually a dividend king with over 50 consecutive years of growth. And it's not a slow growing dividend king either. If we look at the dividend per share chart right here, we definitely see a nice slope on that dividend growth. And looking at the CAGRs, the 5-year is near 14%, which is pretty solid. And the 10-year is not too bad either, coming in close to 10%. Not only that, but if you swooped up some shares of Target right now, you'd be able to lock in a much higher dividend yield compared to the averages. The 5-year average yield is about 2.25%. The 10-year is about 2.7%, let's call it. But right now, in the trailing 12 months, Target's yield is sitting at 3.4%. So that is way higher than the averages. On top of all of that, the positives that we talked about from the earnings report a moment ago, I don't think should be overlooked. Growth in guest traffic, digital comp sales, and comp growth in categories like beauty and food and beverage are signs that Target is still doing some things right in a few key areas. And while the company did lower its guidance, which definitely sucks, some of that has to do with macroeconomic issues rather than things specific to the company. And like I said, they've been able to weather things like this in the past pretty well. This isn't their first rodeo. Of course, Target still could have a couple of rough quarters ahead. We'll see what happens. But if you have a long-term mindset, then I think this could be a good one to consider right now. And now, guys, moving on to our third stock of the day. This one is Mondelez, which I don't know if I've ever talked about here on the channel before, but this is a behemoth in the consumer staples sector. This company owns some of my favorite snacks for sure, and I bet some of yours as well. We're talking Chips Ahoy, Oreos, Ritz crackers, Sour Patch Kids, Triscuits, Wheat Thins, and tons more. And out of the 3 stocks we've talked about so far, Mondelez seems to be the most tame in the last month. They've still seen a decent drop though, still down about 7%. And as far as I can tell, there wasn't anything specific going on with the company that caused this drop. No earnings, no other news, it just kind of generally seems to be going down in share price. But then zooming out, looking at the year-to-date performance, the stock is still down in the red. It's actually down more than what we saw with Target a moment ago. It's down 10% here in 2024, and if we zoom out once more over the last year, Mondelez is down about 7.2%. So for some reason or another, the share price just seems to be lagging with this company, but I think it's creating a pretty good buying opportunity, guys. The financials and the dividend stats are still looking pretty good. Just looking at some of these growth metrics here, the revenue has definitely seen some solid growth here in the last 5 years. The CAGR is coming in at about 8.6%. If we zoom out over the last 10 years, it's a bit more flat, and looking at the chart, it kind of looks like a half pipe. It goes up and down, but more recently, we've definitely seen seeing growth here in the top line. And now moving on to the earnings per share, this does look a little bit choppy. It goes up, then it goes down, but generally speaking, the overall trend is up and to the right. So that's a good sign, and these CAGRs look pretty promising too. The 5-year growth rate on the earnings per share is about 7.5%. The 10 years even higher at 12.2%, so I'll take that. And then jumping over to the free cash flow per share, I think this is looking pretty good. Since 2017, we've seen some pretty impressive growth here in the free cash flow per share, with the 5-year CAGR coming in at about 6%, so that's steady, and the 10 years even higher at about 10%, so I like that. And the cool thing is this growth that we've seen here in the earnings and the free cash flow has definitely trickled down to the dividend and has had a very positive impact there. Starting here with the dividend per share, this is exactly what you want to see, and this hasn't been slow growth either. This has looked really good. The 5-year dividend growth rate is 10.4%, and the 10-year dividend growth rate is even higher at 12.1%. So really solid dividend growth stats right here, and by buying at current prices, you'd also be able to lock in an above average dividend yield. We can see the 5-year average yield is about 2%. The 10 years really not too much below that, but right now at current prices, you'd be able to get a 2.5% yield. And overall, I think Mondelez is looking better than it has in a while, just in terms of the share price. I definitely think it's worth considering, and I think the same is true for all 3 of these companies that we've looked at today. With that though, these 3 are not the only ones. There are still quite a handful of other stocks that I think you need to keep your eye on. With the first honorable mention of the day being ASML, and we talked about this company in last month's video. It was looking pretty good, and just in the last 30 days, it's down another 5%. So another big drop for these guys, and if we look at the year-to-date performance, this is going to leave ASML down about 4.1%. But anyway, moving on, the Hershey Company is another one to keep an eye on, and I'm sure a lot of you guys out there are buying this one right now, and rightfully so. In the last month, it's down about 5.4%, which is going to leave it down about 7.1% here in 2024. But anyway, now moving on to stock number 3, Johnson & Johnson is another one that I think you need to keep your eye on. The share price is getting pretty close to hitting the 140s, and in the last month, it's seen a pretty decent drop. J&J is down about 5.1%, which is going to leave it down about 2.4% here in 2024. And with that, guys, L'Oreal is another one that I think you need to keep an eye on. This one saw a pretty big drop here in November. It's down 9.5% for the last 30 days. And if we zoom out looking at the year-to-date performance, crazy drop, guys. L'Oreal is down 26.6%. We actually talked about this one in last month's video as well. I still think it's one to watch. And then moving on, we've got another French company actually that I think you need to keep your eye on. This is LVMH, which is just a beast, guys. Great dividend growth stock. In the last month, LVMH is down 9%, which is going to leave them down quite a bit here in 2024, down 17.4%. So definitely keep an eye on this one. But anyway, now moving on to stock number 6. This one is Nike. I definitely think you need to still keep this one on your radar, guys. It's down nothing too crazy in the last month, 0.75%. Looks like it's down another 1.5% here just today. But if we zoom out looking at the year-to-date performance, the drop on this stock has been crazy. It's down 24%. So definitely keep Nike on your radar. Anyway, now jumping over to the next stock, Insperity is another one to watch. This one is down about 3% here in the last month, down another 2.1% today. So, combining these, pretty decent drop. And if we zoom out looking at the year-to-date performance, this is crazy. Insperity is down 31.36%. So yeah, I definitely think this is one to keep in the back of your mind at least. And then holy cow, guys, Universal Display Corporation, ticker symbol OLED, saw a crazy drop this last month. I think you should keep your eye on this one. It's down 21% in the last 30 days, down another 3% or so just today. And if we zoom out looking at the year to date, it's going to leave it down 7.8%. So definitely watch this one. And then, guys, we've got Zoetis. I really, really like this company. I'd love to see it continuing to go down, but it's getting there. It's down 4.3% in the last month, down another 2% or so just today. If we zoom out looking at the year to date, this is going to leave Zoetis not at its lowest that we've seen. Back in April, it was under $150 per share, but still year to date is down about 8.5%. Not too shabby. Now, guys, those are all of the stocks that I think are definitely ones to watch right now. And in this next video right over here, I'm telling you about 5 more stocks that have just made my portfolio absolutely skyrocket. 2024 has been one of my best years on record since I started investing, and I owe a lot of that to the 5 stocks in this next video. So click right over here to check those out, and I'll see you in the next one.